What's up, everyone? It's Scotty with MuddyVest. So here we are with yet another live stream for unemployment numbers that are coming out today in under 30 minutes. If you guys can see me and hear me, just give me a thumbs up in the live chat. Just want to make sure the audio and the video is working well, and you guys can see the screen as well now, and of course listen to what I'm saying. So just want to make sure the audio and the video is good. So good morning, everyone. We've got the poll going on right now, so make sure that you do participate on that poll as well, because this is perhaps one of the most important markers for the economy and for the markets and for interest rates, for inflation, everything. Everything kind of starts with unemployment. So jobs report is probably one of the most important reports from an economic standpoint for the markets. So again, hope you guys are doing great, and we are ready. We are going to get started here, and also definitely do share this live stream with other people. You know, invite other people to this live stream, because like I said, it's going to be a very, very important report in under 30 minutes now for the economy and for the market. So join, and of course share with everyone. Perfect. Thumbs up across the board. We've got the poll going on. It's a pretty split way, like almost a third for all these votes right now. 30%, 3.8% and higher. 38% at 37 to 3.8%, and 32% expecting below 3.7% at the moment. So that's where we are. QQQs right now slightly down 7 basis points. Not a big deal because we're very, very flat. We've got the Dow Jones here up over 22 basis points, and the S&P 500 slightly down, again, not really moving anywhere because we're all just waiting for that data to come out. I'm going to share some very interesting and insightful charts with all of you guys, because that's really what's kind of indicating and suggesting that there is possibility for unemployment to start moving higher. Maybe not in the next couple months, but there is a possibility that we start seeing unemployment rate starts moving higher, with unemployed persons also starting to move up. So we've got lots to unpack. We're obviously going to talk about the spreadsheet. We're going to talk about some of the other really important things as well. So let me just see if I can bring up some of these other analysis. So hold on one second. So this right here is the consensus for unemployment at the moment. So this right here is going to be the consensus. So 3.7% is the unemployment rate. That's what the expectations are, with about 160,000 jobs added month over month. Private payrolls at about 150,000. Manufacturing payrolls at 5,000. We got participation rate at just under 63%, and average hourly earnings at 0.3, and year over year sitting at 4.3% for employment. That's what the expectations are going into this print. Okay, let's see. Loud and clear. Is it out yet? Nope. So it's going to come out in under 30 minutes. At 8:30 a.m. Eastern is when the numbers come out. Do also participate in those polls. And right now, of course, 76% probability that we're going to see a potential rate pause once again in November. So November 1st, end of October, and November 1st is when the next meeting is. And of course, we've got majority of those gains for the jobs market, for the labor market, coming in from private education, health services, leisure, and hospitality. Construction's been growing as well. We've got government jobs being added and other services, and we'll find out what the most recent report looks like for the month of September. Now, there's one more chart that I think is going to be very important. There's actually a couple of charts. The first one is over here. Now, why is the jobless claims a very leading indicator for where unemployment goes? It should be a pretty straightforward answer, but I'm still going to ask you guys, and that's going to be part of that SoFi Q&A. So if you guys can answer that, you know, I'm of course going to be buying SoFi shares. But why is jobless claims a very good leading indicator for unemployment? Let me ask you this simple question. This should be pretty straightforward, right? Probably one of the easiest questions I'm going to ask you guys all day on this live stream. But, you know, comment in the live chat, and I want a lot of participation. I want a lot of people to participate, engage, so that, you understand things better, you understand these concepts better, and you can obviously talk to other members as well. So definitely do type it out in the live chat. Just want to make sure that that is indeed working. Why do I feel like my live chat is now frozen? Okay, let's see. Is it working right now? Okay, it should be. I feel like my live chat might be frozen, because all I see is right now the same comments. I'm going to wait, see if I need to refresh or restart the live stream here. Yeah, I think I may need to restart the live stream because my live chat. Oh, it's not. Okay. You guys were just too quiet. Oh, okay. So it is working now. Okay. Well, it was working. Okay, good. Um, okay, perfect. So, is there a delay? Yeah, there could be a delay. Um, anyway, so the question is why. Yeah, people are claiming that they lost a job, which means that they are unemployed. Very good. So, and you'll notice that this right here is one of those charts. So where we have the unemployment number, unemployment rate, is going to be in orange, and jobless claims are going to be in blue. So that blue number is going to be. I just want to make sure that that is indeed correct. U.S. unemployment. Let's see, ICSA. That's going to be initial claims. So initial claims is actually going to be in orange. So that's what we have in orange, and the blue is going to be the unemployment rate. And what you'll notice is, of course, they've both moved in tandem with each other. They've both kind of moved together, where initial claims have gone up. Some instances, you'll notice that the initial claims actually goes up before the unemployment rate. So this right here, for example, you'll notice that the orange line is preceding the blue line, meaning the initial claims have gone up before the unemployment rate. This right here, almost, somewhat an identical pattern where the orange line is a little bit preceding than the actual blue line. And this, of course, was also very similar, where you've had the actual orange line a little bit preceding the blue line, which is initial claims being filed before the unemployment rate starts to go up. So right now, we've still seen the initial claims are very, very low, and unemployment rate also really, really low. So that hasn't played out yet, because every single time in the past, you'll notice spiking both together at the same time, spiking both together at the same time. Again, both of them going up at the same time. The orange line kind of preceding the blue line, which is initial claims going up first, and then unemployment follows. We haven't seen that yet because, like I said, we are both very, very flat here on both of these numbers. That's why I mentioned the jobless claims, initial claims, very, very important indicator, leading indicator for the state of the labor market and the state of the economy. One more chart that is very important to follow is going to be this one. Now, this one, what this tracks is the spread between the 10-year and the 6-month. So that's going to be this right here. The candlestick chart you see, it's a 10-year versus 6-month spread. And the blue and the orange are going to be the unemployed persons and the unemployed rate. Okay, both of them, unemployment rate and unemployed persons. And they obviously should be moving together as well, because as there's more unemployed persons, the unemployment rate also starts to move up. And what's interesting is that we haven't seen, right? So we've talked about this in one of our previous videos, that the recession hasn't happened on the spread turning negative, but on the spread going back higher, right? A lot of the times recession warnings and signals and indicators have popped up, not on the way down, but on the way back up. And that's exactly what's happened in the past. So this is 2000s, this is 2007, 2008, this is 2020, and this is where we are right now. And I want to definitely draw this conclusion where every time the spread between the 10-year and the 6-month is on its way back up is when you've seen the unemployed rate and the unemployed persons, both of them move up at the same time. You can kind of see that in this circle, right? The spreads are turning back positive, and both of these charts are going up at the same time. Same thing over here. They're all three moving in the same direction together. This right here, same thing, right? If you compare this to 2020, let me just lower this a little bit. So you can see that as soon as we started moving higher for this spread, that's when these spiked back higher. Well, guess what? We are once again moving back higher. We're starting to see that rotate back up to the upside, where that spread is now once again starting to move up, potentially to this positive territory. But as I mentioned in my previous chart, right now unemployment is not moving. It's very, very tight. It's very, very strong. And as a result, we haven't seen any sort of recession signals or warnings or anything like that. But it's only a matter of time, in my opinion. And again, you guys feel free to chime in. But this right here is what the discrepancy is, where the spread's moving higher as it's done in the past, but unemployment is not following through. But eventually, I do believe with the time lag of higher interest rates, higher for longer, it's possible that unemployment also starts to move back higher. So that's going to be something to keep in mind, of course. So John says, with Cybertruck and new Model 3 coming out this quarter, do you still think Tesla is going to go below 240s again to be able to sell your Tesla option for more profit? So that's for a separate question. We're focusing on employment right now, but very quickly. We'll cover Tesla in a separate sort of more dedicated video, and I'll go over that, during market open. But even at a 70-80% profit, like I'm comfortable getting rid of those options for Tesla. Right now it's down about 1.5%, so 255. So I already closed one of those options and then opened a new one for a lower strike and a little bit less of an expiration. That's right now in play at the moment. So the Fed said soft landing. Soft landing, something that's been mentioned so many times in the past. I did a video on this earlier today where it's kind of like identical to what we have already seen back in 07, 08, and also back in 2000s and also in 1980s, where there's been a lot of articles, a lot of news pieces, a lot of headlines from the media that they've mentioned the word soft landing on their articles and news channels and everything in their pieces. And that's preceded a recession almost always, right? In fact, always. It's preceded a recession. Soft landing has turned into a hard landing reality every single time. So will this time be any different? I mean, it's possible, but I doubt it. And NBER, which is the National Bureau of Economic Research, they are usually several months late when declaring a recession. And I think that's what's going to take place in 2024 as well. It's possible that if unemployment rate starts to move back higher, like I said, there's got to be some time lag with this because this signal is already moving back up. Unemployment is not following through. But eventually, if it does, I think NBER is going to come out and be like, you know what? We were in recession for quite some time, and that's going to potentially put some impact on the economy as well. So we'll see what happens with unemployment later today and, of course, over the next few weeks and months. Is it possible to increase supply to meet the demand instead of increasing unemployment? So increase supply. Well, Marks, how do you increase supply of employment? I mean, there needs to be more people entering the workforce. So right now there is shortages, right, in the labor market because there's more job openings versus unemployed persons. And even then there's a lot of mismatch. So that ratio is 1.55. In order for you to increase the supply of labor, there needs to be more people entering the labor market, the workforce. And right now, the U.S. population, 332 million. People who are over the age of 16 that are eligible workers, that's 266 million. But even then, I mean, you've got people in school, people in college, universities, also people that are retired, disabled, can't work, don't want to work. Like there's a lot of people in that category. So that participating population is 166.5 million, which is around 62.6% of the total eligible workers. So in order to increase the supply to kind of get to an equilibrium of that demand and supply imbalance because of labor shortage, this participating population needs to go up. This needs to go up to 175 or 180 or 190. And you can see the unemployment rate dropping down, right? Dropping lower. But how do you add all these people into the labor workforce, right? The participation rate has been at 62% for a very long time. That's pretty much the norm where it almost always is. I mean, the great inflation, 1970s, it dropped down to under 60%. Fewer people participating. The population was also lower back then, 226 million. And over 80% of the population, again, was over the age of 16. Eligible workers, 182 million. Unemployment rate got up to over 10.7% because we had over 11 million people unemployed back then. Dot-com bubble, again, over 60% participation population. Great financial crisis, 62%. COVID, over 60%. And right now, we're over 60%. So we've actually got more people participating in the labor market, and yet there's still shortages. And that still puts over 6.19, 6.3. Right now, I think it's 6.36. So, or actually, yeah, that's going to be that number. 6.12, 6.2 million unemployed persons. So that's where we are with that regard. Viking says people need to have more kids. Yeah, I mean, that's another potential problem, right? That Elon Musk has mentioned that population is declining. People are not even getting married, let alone have kids, right? So there's been several reports that have been coming out from Bloomberg, from CNBC, from different sources that are suggesting that, marriages are in decline or population's in decline. And that's obviously an overarching bigger problem for the civilization, for literally just the human species in general. But let's just come back to unemployment. We'll figure some of the bigger problems out later. But yes, that is also another issue. Okay, because reporting time lags behind claims. Yep, so increased retirement age, that's possible too. You expect 100% population to work? No, No, I mean, that's never going to happen. I mean, you're never going to have 100% of the population work at any time. That is just not realistic. So 62% is pretty realistic. That's been the norm. That's always been the norm. And you can see that from the last, 50 years or so. That 62%, 57%, that's been around the number, right? A little over half the population. So you'll never have 100%. There's no way. Good morning, Caddy. What are your thoughts on STRL PEG ratio of 0.55, P of 18, and seems to be great fit for the upcoming infrastructure funding package? So all these stock analysis will most likely do like in the next 45 minutes at around 9 a.m. Eastern. I'll definitely put this on the watch list. But right now, the focus, Frank, very much is on the unemployment numbers. So I'll add it to the watch list, STRL. And then we'll take a look at this, after the unemployment numbers come out, because I want us to focus very much on employment, and then we'll shift gears towards stock analysis. What time is the numbers coming out? Is the report out? No. So 15 more minutes. 15 minutes is when the report comes out. So I will be obviously putting up CNBC. We'll be listening into the report coming in, and then we'll take a look at the charts and the market's reaction, and then we'll analyze the report ourselves. So definitely share this live stream, drop a like so that more people can join. The algorithm will push this live stream out to more people so they can join us as well. And also definitely do participate with the poll right now. We've got 189 votes. Let's see if we can at least get up to over 300, 400 votes in the next 15 minutes before the report comes out, so we have a good consensus overview of where you guys believe unemployment rate's going to be. So do all those things. Drop a like. Right now we're at 61. Easily get up to over 150, close to 200, and participate in the poll as well. What price would I be DCing in AMD? I don't mind dollar cost averaging, at these levels. I do like advanced micro devices from a long-term perspective, but ideally I would be looking at sub $80. $80 is kind of like my fair value, so anything below that level would make it a lot more attractive, in my opinion, for AMD. So those are the prices on a very rough basis. By the way, you can get access to the intrinsic values, our entire Google spreadsheet, and our Google Docs for individual stock reports through our Patreon. So we're going to be doing like a whole rebranding over the next couple of days, where you're going to be able to access all these reports, all these spreadsheets very, very easily. So everything's going to be available with a link down below. Okay. 8:30 is when the report comes out. We've got another 13 minutes left. Markets right now are very, very flat. So Apple's up over 29 basis points. Tesla is definitely selling off a little bit of 1.6%. I did a video on Rivian as well, so make sure that you do check that out if you haven't already, because it'll give you a little bit more context with what's going on. Because the company, yes, went through like a $1.5 billion convertible note offering, but it's actually not as bad as it seems. So that video explains everything in more detail. But I know the sell-off was pretty brutal yesterday, down 22% after the news came out. But the terms are actually pretty good. I'm kind of surprised that Rivian was able to lock in that rate for the next 7 years. So that video kind of explains that in more detail. Does it matter what the market does in the short term if earnings are going to crush it when the markets just react in a positive way, providing momentum through year end? So that's the thing, right, Frank? I mean, earnings, yes, the expectation is that they're going to come in strong, but with interest rates as high as they are, and for as long as they are, who's to say that consumer spending can't or won't pull back in the future? So the thing is that, market memory is very, very short, right? We tend to look at last 2 months, 3 months, and think to ourselves that, okay, yeah, well, the earnings are good. I mean, the economy is great. The markets are up. Things are good, right? That's how we start to think. But we often forget there's things happening in the background that may not be visible, in the moment, but there's bigger time lags, there's bigger cycles, there's bigger things that can be in play that eventually create a bigger problem for the market, for the economy. Because look, the government shutdown, that was a big overhanging pressure, but that's only the can's been kicked down the road from October to November. So November comes and we're gonna start seeing that resurface once again, because it's not a permanent solution, right? We're just putting Band-Aid into a wound, and at some point we have to kind of deal with the real problem. So that's why I think, yes, earnings are good right now. Economy is growing, unemployment is low, but with higher interest rates and the longer they stay there, the bigger the problem could be, because we haven't seen these rates in over 16, 17 years, right? And in my other video that I mentioned, definitely do check that out. So from 16 years ago, if interest rates are not as high as they've been, in 16, 70 years. The fiscal side of things have only gotten worse. Record amount of credit card debt, record amount of mortgages, delinquencies are on the way up, right? Total amount of debt, it's significant, right? $33 trillion. So the fiscal landscape has worsened, and we've got now interest rates at highs of 5-6%. So it's really kind of thinking about it in a more logical way, right? How is it possible that everything stays intact over the next several quarters and several years? If it does, it's going to be shocking to a lot of people, right? If it does, that's great. Nobody obviously wants to see like a crisis unfold, but you just think about it logically, right? I mean, from 16, 70 years ago, fiscal policy has only gotten worse. Fiscal debt, fiscal deficits, the mountain of interest payments, everything. And of course, interest rates are so high. So how can things continue to be intact? Markets ride well, ride a wall of worry and usually go down with euphoria. JT, Caddy, aren't you doing daily live streams anymore? So we're probably just going to be doing live streams mostly on specifically important days like inflation, FOMC, interest rates, unemployment like today. But for daily live streams, I do like to spend time, trading as well. And then, of course, spending time with our community in our Discord. So I'm going to be more active there, answering questions. But I think that's going to be more helpful. But then more important days like today, we will definitely be live. Okay, so we've got 9 more minutes left for these numbers to come out. I think we have already covered majority of those things, but this is going to be that employment persons that's going to be the most important. That's what I'm going to be paying attention to, the civilian unemployment persons, right? So right now we're sitting at around 6.355 million, and that obviously has been just going sideways between 5 and 6 million. So we'll see if we actually do see an increase on that. We'll take a look at the additions by industry, and of course the unemployment rate, and then that ratio of JOLTS versus unemployed persons. So JOLTS we already learned earlier in the week, 9.61 million. That's a huge increase, right? So that's a lot of job openings again in the US at 9.61 million. That's a lot. And then unemployed persons, we'll plug that number in to see where that ratio sits. And that, I think, is what's going to dictate market's expectation of interest rates and the reaction from the markets as well. So yeah, that's where we are. Yep, so it's still the best place, no doubt about it. Gaurav, yeah, things are great. Things are amazing in Dubai. I absolutely love it. Honestly, it's been amazing 2 months, and yeah, I love it. Can't complain. The only thing is that obviously I am very much of a cold, like a weather person. Like I don't like the heat and the humidity, and Dubai is like very close to the equator, so you get like direct sunlight, and it gets really, really hot during the summer. So the weather, I guess, is, if you are somebody who loves the hot weather, the sunshine, everything, I mean, Dubai is like the perfect place, but I like the cold. I like the snow. So that's the only thing, I guess. Okay, so definitely do vote. Drop a like. We still haven't reached 100 likes, guys. Come on. Drop a like here. 363 people watching. We're going to cover the unemployment numbers here in just a minute. But overall, Tesla here down 1.6. We got Nvidia here slightly lower, Microsoft pushing higher, we got Apple slightly pushing up. And then let's take a quick look at some of the other companies. Like, for example, Meta, we've got slightly down, AMD here, flat overall, PayPal, slightly up, Square, 63 basis points, Enphase, and we've got slightly higher, 18 basis points. So very, very flat, right? Entire market's like almost very flat here at the moment. John, why didn't you get rid of your option on Tesla in the 230s? So Tesla, I don't think the last time Tesla traded in the 230s. I guess it did. It did, in last week of September, it was down in the 230s. Only because I think it was only up 70 or 80%. I'm looking for at least over 95% on the specific options because those were calls that I rolled over. So that's why I've got a much higher profit threshold on those versus some of the newer ones that I'm selling. That's fine with 60-70% profit. But the original ones that I've rolled over, I'm looking for at least over 95% plus profit on those, and they didn't get up to that threshold at the moment. So as soon as they do that, then I will be looking at getting rid of those options as well. We'll be buying them back almost for pennies on the dollar. All right, so let's just do a audio check with this just to make sure that we are good. If you guys can hear this, then we should be good because we've got 5 minutes. 5 minutes left for these numbers to come out. And the market's reaction is going to be pretty interesting.
And if you tell me that funding the pension of a Ukrainian bureaucrat is in America's interest, I don't see how you can sell that to American taxpayers.
Governor, I wanted to return to the way you think about the role of the government and policy as it relates to business, and specifically just speak to the Disney issue again. And the issue is that
pay for it.
year, 2 years out, or even when you're selling some of these products,
is the audio good?
Clients, are they saying, you know what? If we buy these products, if we buy these services from you, Michael, the good news for us is that we're actually going to be able to slow our hiring plans in the future.
Or dedicate more of the freed up capital resources toward new growth initiatives. And it'll be some of both.
And how, it'll be some of both. Is that similar for you too?
Sure.
Where do you see the opportunity in that regard then? Conservatives and this is Bradley Devlin and many others in interviews that the timing was completely. That's why people look at this and say.
Okay, I think we're good. Less than 3 minutes, folks. 3 minutes. Definitely do participate in the poll. And what I want to do really quickly is also get a good sense of where you guys are watching in from. So, it gives us a good understanding of, how many people are watching from, how many representing different countries. So definitely do comment where you're from, where you're watching from right now, the country. So I can also look at it, from a very nice, cool perspective of how global our community is. So definitely do just simply type where you're from. We've got less than 3 minutes for the unemployment numbers. So I want to definitely build you guys up to this very, very important metric. So comment, everyone. I want to see a long list of everybody that's tuning in right now and where you guys are watching from. So definitely let us know. So we got Philly, we got Denmark, California, Georgia. That's amazing, guys. Singapore, Egypt. Wow. So I want to see what's going to be the most rare, most interesting country that we can find here. Dubai. Wow. My neighborhood. Poland, Malaysia, Paris, Canada, India. That's awesome, guys. Minneapolis. Love Minneapolis. Thailand, Germany, Barcelona. Shout out to each and every one of you guys. I know it's different time zones for everyone, but I appreciate you guys tuning in right in the morning here at 8:30 a.m. Eastern so we can cover the unemployment numbers and, of course, take a look at the markets and how that reacts and how, interest rates change. Kevin, shout out New Jersey, UK. We got Netherlands. That's awesome. Couple people from Netherlands, Singapore, Cambodia, the Earth. That's awesome. That's awesome. Thank you so much, you guys, for joining in. Appreciate it. And let's do this. Let's do this. A minute 30 left. Minute 30. For the numbers to come out. Hong Kong, we got Romania, Estonia. Man, these are some very interesting places. Come on, Antarctica, really? Ireland, Long Beach, California, Miami, Portugal. Portuguese in Germany, okay. Florida, Minneapolis, shout out, Siberia. All right. Thank you so much, you guys. Hawaii. I love it. And we got 1 minute. 1 minute left for these numbers to come out. So I'm going to...
Because you need them to support you, but you need to differentiate from President Trump. I mean, Hillary Clinton just said something like, maybe that cult needs some go to some re-education training or something just to get out of the Trump cult. But you see what you're up against and how difficult it is.
Yeah, but I reject that. I mean, look, these are patriotic Americans. They want to see the country do well.
How do you keep them, though, if you attack President Trump? You've had trouble walking that fine line between really attacking him and not wanting to alienate his supporters.
There's a lot of differences. This is all fair game. These folks get it. They want to see the country do well. Some people will be with Trump no matter what, but I think the bulk of the people are people that appreciate what he did. They also understand that he's got limitations in terms of his electability. He's going to be he would be a lame duck on day one if he could even get elected. I think he'd have major problems with personnel.
Okay.
And of course, he didn't deliver on his core promises
Okay.
to drain the swamp, to have
Governor-
Mexico pay for the border wall, or to eliminate the debt. He added $7.8 trillion to the debt.
Okay.
So that's all fair game. We're going to be able to make that case.
Great.
And I've delivered on these policies
Okay.
better than anybody.
We got, you know what's coming up in about 8 seconds? We got these jobs numbers. That's the only reason I'm cutting it
No
off right now.
worries.
Great. Please come back. Thank you, Governor.
All right, let's get right over to Rick Santelli with those numbers. Rick, take it away.
Yes, jobs numbers for the month of September. Non-farm payroll, a whopping 336,000, much stronger than what was expected in the 165 to 170,000 camp. And if you look at the unemployment rate, it remained at 3.8%. It remained at 3.8%. And if we look at average hourly earnings, they also remained it up 0.2%. Now, real quickly, up 3.8% happens to be the highest since Jan of 22. So we remain at that level, even though it's 2 months running. And on the wages, month over month, average hourly earnings up 0.2. That is the smallest since February of 22, and it remains the smallest since February 22 with back-to-back months. Let's take a year-over-year perspective. Average hourly earnings are 4.2%, 4.2%. That is the lowest level going all the way back to June of 21, 4.2%. And average work week, 34.4. We've had a lot of 34.4s. 34.3 happens to be the lower realm, but we're very close. And 62.8 on the participation rate, it remains there. That's back to back, which means best since February of 2020. And finally, what I referred to as U6 is the underemployment rate. That's 7%. It was 7.1. 7.1 last month was the highest since February of 22. Now, I don't see the revisions. I don't see the revisions because we do have a record I want to pay attention to. Through July, every month has been revised lower, first time since record keeping in 1979. Interest rates have moved higher. We've moved basically up towards the 479 to 480 level. And if you look at pre-opening equities, they have moved lower. Obviously, it's the headline number of jobs because one could make a case that much of the rest of the data is actually on the softer side. And we want to pay very, very close attention to how ultimately this moves the yield curve, which, by the way, Tuesday 10s is now under 30, minus 30 basis points at minus 29. Becky, back to you and the panel.
Holy cow, Rick, that is a lot to digest. Stay with us. We want to bring in the rest of our jobs panel for some instant reaction on this. We've got Jason Furman, who's the former Council of Economic Advisors chair, now a professor at Harvard's Kennedy School of Government. Tyler Goodspeed, the former acting CEA chair, who's now with the Cato Institute and the Hoover Institution. And Sarah Malik, who is CIO of Nuveen. Of course, Rick is here along with Steve Leisman. And Steve, let's get your takeaways because you've noticed some pretty interesting things in these numbers too.
Well, the revisions were up. I don't know if you remember what I said in the last hour, that they've all been down until now, and I think we added 119,000 jobs in the back months, and that's strong. The unemployment remaining unchanged, no addition to those longer-term unemployed. You're just showing a lot of strength here, but you also have maintained this participation rate, which is good. I think the Fed would look at this and say, you know what, we seem to be having the workers, and they're not coming at a higher price, right? So the 0.2 on the wage number is going to say, you know what, we have strong employment, we have the workers to fill it, and they don't appear at the moment to be demanding a whole lot of extra money to come back to work. We've seen some of the job growth where we saw it before. I think I saw a number in leisure and hospitality of up 92,000. That's a big number. We did have a 29,000 jump in state government education. There's been some seasonal adjustment stuff of how many teachers were fired or hired or came back. So we kind of expected a pop there. But when you put together this blowout number, right, together with the prior two upward revisions,
and the JOLTS report from earlier.
And the JOLTS report.
You get minus 250 on the Dow.
Well, you get minus 250 on the Dow, but you also get a big kind of slap in the face to those Fed officials that have been saying we're seeing softening in the labor market. And that's what we want to see. So I don't know that the Fed is in a place right now where they're going to be abandoning their belief that in order to bring down inflation, you have to soften the job market.
Look at the jump that we've seen in the 10-year and the 2-year, too. 2-year is now at 5.14%. The 10-year is above 5.8%. Those are significant jumps that we've seen since this number hit. Sarah, the move in the market, is that an overreaction to you, or does this make complete sense given these numbers?
This headline number is going to shift the market to continue to digest, moving away from a soft landing to a hotter for longer economy, and that's going to be negative for the markets. There are a couple of silver linings, though. Labor force participation and average hourly earnings. I think quit rates are continuing to moderate. That's keeping a lid on wage inflation, but we need to dig into non-farm payrolls here and look at, first of all, what are revisions going to be? They have been basically negative most of the year, so that could be a positive. And also from the JOLTS number, are professional services continuing to grow? If that's where the growth is, I think then there could be upside to wage inflation, which isn't great. But I think the JOLTS number was mostly just noise in this number. So the markets now have to wait for the next catalyst, which is going to be Q3 earnings, and see if companies are saying that the economy is still working their earnings and their margins, and that the companies can beat and raise.
Hey, Jason, what do you take away from this? You were worried for a long time about the Fed's activities and what this means. At this point, it may not be the Fed that's really calling the shots.
Yeah, look, my first reaction to these numbers was really just being surprised and shocked. My second reaction was feeling decently good about them. We're creating jobs at a clip of nearly 300,000 a month over the last 3 months. That is way above what you need for the normal replacement rate. But we have seen a higher participation rate. So maybe what we're seeing here is labor supply, not labor demand. Some evidence for that is average hourly earnings. It isn't just the low number this month. Over the last 3 months, they've risen at a 3.4% annual rate. If that continues, that is fully consistent with inflation in the mid to low twos. My biggest worry is that prices had been moderating, but that it wasn't going to be sustainable, because you are going to continue to see very rapid nominal wage growth. With that wage growth coming down, maybe what we're seeing here is labor supply increasing, jobs being strong, and you can do that without inflation.
So meaning that all of these people who hadn't been working to this point, all of the people who hadn't been working to maybe their full potential because they had excess savings from COVID, maybe they've run through those savings, they're coming back into the jobs market, and employers don't have to pay a much higher salary to lure them back because they need the work?
You should be teaching my class instead of me. Exactly right. That's exactly what I was saying. Plus, you have a bunch of immigrants coming here, too. In terms of the Fed, the 10-year has risen so much. That is doing a lot of work for them. I think at this point, frankly, they should have a high bar to raise rates. And given what we saw in wage,
All right, everyone. So that was such a hot print on unemployment. So 366,000 jobs added in the month of September. Unemployment rate is steady at 3.8%. So that's where we are sitting right now. So 3.8%, 336,000. That's a huge increase. And the prior number got revised by 100,000. So we're sitting at 227,000 for the previous month. Not September, but for the month of August, and September was 336,000 jobs. Where are these jobs coming from? A lot of them came from leisure, hospitality, private education. So employment, by industry, if you come down here, monthly changes, we're looking at a lot of the jobs gains. We're in the private education, health services. We got leisure, hospitality, and the government sector definitely adding a lot of jobs as well. 73,000 coming from the government sector alone. Professional business services, 21,000. We did lose jobs in IT, which kind of makes sense because of all the layoffs going on in the information technology sector. Utilities were up 4.8 thousand. Retail, trade, mining, and lodging was up. And then we did also see construction and manufacturing also up 17 and 11,000 respectively. So, that sector is also a very good leading indicator of potential, recession signals. But man, the labor market's super, super tight. Like it's unbelievable how incredibly tight the overall labor market is right now, given the interest rates as high as they are. But again, Q4 is really when it begins, right? So October, November, December. So Q4 of 23 going into the Q1 of 24. Those 6 months, I think, is really what's going to make it or break it for the labor market if we can sustain at these high interest levels. interest rate levels or not. That's really what's going to dictate that. Now, the markets obviously did not like that one bit. We've got S&P 500 down 81 basis points. We got QQQs dropping over 1% instantaneously and on the back of these stronger numbers, because that only paves the way for the Federal Reserve to keep interest rates higher for longer and increases that possibility for them to raise rates further, right? 25 basis points has been the consensus according to the Federal Reserve members. The market very much has been pricing in rate pauses. And right now, there's a 77% probability that we're not going to see a rate hike in November, although this number will get updated here very soon, because it does take time to update markets' expectation, because given how strong the economy is, with the labor market that we just got, it is absolutely a possibility. I think the possibility for rate hike only increases with the strong jobs report. Unemployed persons now sitting at 6.36. I think it's almost similar to what we got previously. So that is going to be, so unemployed rate sitting at 3.8, and then unemployed persons is going to be sitting at the same level as where we were. So 6.355 to 6.36. So that's where we are. And the ratio is 1.51 after accounting for the JOLTS numbers at 9.61. So yeah, I mean, this is still a very hot, very tight labor market that continues to show that, the businesses are hiring and people are finding jobs, which is going to, again, pave the way for the Federal Reserve to keep interest rates higher for longer and keep raising interest rates. So that's one thing. And markets here obviously dropping, and we got the dollar index pushing up 0.31%, and the yields got up to 4.8%. So we are now at over 2% increase on the day. They got up to 4.8.5%, and I think the next level for the yields is pretty much going to be closer to 5%. I think that's really what they're eyeing. High has been a 4.884, so we were very, very close to getting up to 5%, but this really is going to be that level to watch for the 10-year yields, sitting roughly around 5%. We're not that far off from that threshold, and that would be such a huge psychological level for the market, because at that point, 10-year treasuries at 5, not to mention the shorter end of the curve, which continues to move higher as well. So you've got, the 6 months sitting at 5.6. Guys, this is insane. Man, if it gets up to 6%, like 6 month, can you believe 6 month return, like on an annualized basis, of course, 6%. 6%. What that does to the risk curve, I can only imagine what that's going to do to the risk curve, because everything's going to be based off of those risk-free rates at 5-6%. Now, everything's going to get pushed out on the risk curve. People are going to take more risk to generate a higher rate of return, because you can get a 6% for free. Literally for doing nothing, investing in treasury bonds, you can get a 6%. 5.5% for 3 month, 1 year sitting at 5.4.5 right now. So, man, oh man, this is about to get really crazy if the yields continue to push higher. Now, one more thing I want to mention is there's a silver lining. They were right. There is a silver lining, and the thing is, Fed dual mandate. If I go over exactly where we are at the moment, and inflation is really what's going to dictate a lot of this, because we don't want to get into this dilemma for the Federal Reserve, and this is something I mentioned in my yesterday's market update. And the bottom line is that this is the Fed's dual mandate, right? They want to be right in the middle. They want to be right here, right in this circle is where they want to be. That's going to put us at around just over 4% unemployment and about 2% core inflation. That's been their goal, right? That's been the number that they've been telling us: 2% inflation, 2% core, 2% core. So that's where they want to be. And this is the unemployment rate. That's their target, right, for the dual mandate. Right now, they're all the way over here. They're over here, right? Something that I've mentioned before, because they are very, very low on unemployment, right? Because unemployment is strong, so we are very low on unemployment, but we're also very high on inflation. So that's going to be inflation line, the y-axis, and the unemployment is going to be on the x-axis. So we're all the way up here. So what the Federal Reserve wants to do is bring this number down to more like this. That's why they're okay with the labor market weakening a little bit. That's why they want the ratio to come down, right? The ratio that we've talked about, JOLTS to unemployed persons. But they're not successful in doing that so far. With higher interest rates, the labor market doesn't budge. The worst place the Federal Reserve can be, what's the worst place the Federal Reserve can be? Let me ask you guys this question. In these 4 quadrants, 1, 2, 3, 4. There's 4 quadrants here. What's the worst place the Federal Reserve can be? What's one place, which quadrant we don't want to be in? Answer that question. Let me see if anybody can get it. And if you can, then of course I'll buy SoFi shares because that's a Q&A. But which of these quadrants do you believe from a Federal Reserve standpoint in the dual mandate we don't want to be in? That's the last place we want to be in. 1, 2, 3, or 4. Which quadrant? Just type in the number. Which of these 4 quadrants do you believe we don't want to be in ever from a Federal Reserve standpoint? Okay, so I got a couple 4s. I got 2s. Top right. Okay, perfect. A lot of you guys answering 2. Kevin saying 1. 1. You guys sure about 2? Think about it. Think about it. I really want you guys to think about it because a lot of you guys said 2. Are you sure about it? Think again. You sure about 2? Think about it again. So we got 4s, 1s, 4s. Avi says 2. Cool says 1. So type in which quadrant would be the worst place to be. So now I got a couple people changing. So okay, no, you guys are absolutely right. Majority of them 2. I was trying to trick you guys into thinking whether this is going to be correct or not, but no, it is indeed correct. This is the worst place the Federal Reserve wants to be, because that would basically mean both high inflation and high levels of unemployment, right? That would basically be the worst of both of their dual mandates. So that's not where we want to be, and eventually, that kind of feels like where we're headed because, well, not from a standpoint of unemployment yet, because it's very, very strong. The labor market continues to be very strong. But if in the next 6 months, as I said, from Q4 23 to first quarter 24, trick question 5, but if the labor market starts to weaken, then that is where we could head over to if inflation doesn't come down fast enough. So it's kind of like this game of chicken where the Federal Reserve is trying to make sure the labor market says as strong as possible for as long as possible until inflation comes down. So really, it's just that timing issue where they want to make sure they bring inflation down before unemployment gets out of hand. You get what I'm saying? Because if that happens both at the same time, if inflation doesn't come down fast enough, it stays elevated, unemployment starts to break away, well, then we're in this second quarter. We're in this situation where both of them are going to be higher at the same time. Then Federal Reserve will have no option but to really cause a even worse recession. Is it a jokester? Yeah, I mean, no, the correct answer is 2. You all got it, so congratulations. Most of you got it. But yeah, the point is that we are here. Federal Reserve wants us to get down here. But if interest rates stay higher for longer, it's possible that we do end up, on the right of this. Now, if inflation comes down, unemployment increases eventually. This is not a huge problem because the Federal Reserve can indeed lower interest rates, right? So what would they do to fix the situation if you're in quadrant 4, if you're all the way up here? So like eventually 6 months from now, 12 months from now, let's say inflation's back down to Fed's target, it's even lower than the Fed's target, and unemployment spikes to over 4%, 5%, 6%. Let's say they were in quadrant 4. What would the Federal Reserve do then? What do you think would be the tool that they would use if you were in quadrant number 4? A lot of people actually do believe that we're going to end up in that quadrant where unemployment is going to be higher, given how high interest rates are. So eventually it's going to start to break, but inflation is going to be back down. So what do you think the Federal Reserve is going to do if you're here? So Mihai says they will cut rates, decrease it. Yep, so exactly right. So they will cut rates to bring, to support the economy, to start quantitative easing, and then of course bring unemployment back down to 4%, probably under 4%, so they can get this back to the level that they want it to be. But there's a lot of, obviously the severity of it, the aggressiveness of it, and I'm really hoping the Federal Reserve's learned their lesson. Well, I guess that's a lost case, but hoping that the Federal Reserve learned their lesson from what we have seen in the past, where they don't immediately cut rates down to 0%, because that creates so much quantitative easing at the same time, which obviously results in higher inflation. So it should be staircases up and staircases down. But unfortunately, the Federal Reserve is used to taking staircases up and then elevators down in hopes of supporting the economy to make sure that we don't have a severe recession. But I do believe that in order to keep inflation under control. And from this to happening again, they need to take staircases up and then staircases down as well. So that's where we are. Dollar index 106.9, up 0.5%. Yields 4.8.5%, almost getting up to 4.9%. Crazy numbers. And we got the Nasdaq here down 1%. We got the S&P down 92 basis points, and of course a lot of individual stocks like Tesla down 3%. We got Nvidia down 1.5%, Microsoft 1.3%, and Apple here down almost 1% as well. So lots of red coming in. We got a brace for impact here. And let me just go over to some of the comments now. So print more money or quantitative easing, that's just part of quantitative easing. QE, they'll start to cut rates. Most of these numbers are seasonal workers and an overreaction here. So it's kind of hard to say, but a lot of them, you could argue that these are seasonal workers because a lot of them have come from leisure hospitality sector, 96,000, insane. But we've seen in the last 12 months, private education and health provide the most amount of jobs, followed by leisure hospitality, followed by government jobs. So yes, you could argue, leisure hospitality kind of leading the way over the last 3 months, including private education and health, but that hasn't pulled back at all. So in other words, people who are being hired are staying at those jobs because I think the companies might be, because of labor shortages, it's also possible the companies are just not laying people off. They're just not. They're just too afraid. They're too afraid to lay people off because they had a hard time finding labor when there was so much demand. And so now they're just like keeping employees on the payroll. They're not letting them go because they fear they may not be able to find the replacement when they need them the most. So that's also a potential reason why employment continues to be strong. And that's from more of a company standpoint because companies are able to finance all this cost right now. Yes, interest rates are high. So eventually that cycle also is something that we need to pay attention to because a lot of these companies, let's say they start kind of running out of cash. It's not so much about consumers running out of cash or businesses start running out of cash and they need to finance, take whatever, line of credit or start borrowing debt in order to keep people on the payroll. That interest rate is obviously going to be much higher. So that's going to show up in their income statement as an interest expense. That's going to lower their earnings. And the moment that companies make that decision, that'd be like, okay, now we need to make some cost-cutting measures. We need to save a little bit. That's when they start these layoffs, and that's what leads to potentially higher levels of unemployment. So I think that's another reason why there's so much demand for labor at the moment. So demand walking, so mostly on important days like inflation, FOMC, interest rates, all those things like unemployment, we'll have live streams for that. But on regular days, I think I want to spend some time with our community members, answering questions in our Discord. So I think that will be more valuable to everyone. Okay. I won 3,800 on SPY. Keep it coming. That's going to be pretty brutal for the markets. I think 4,000 is where my fair value is. TQQQ up play. So TQQQ probably is going to be down quite a bit. I may end up dollar cost averaging maybe a little bit. But again, just you got to be careful. Down almost 4%. I'm watching this support at around $33, $33.50 to see if it actually breaks below that level on the Qs. But you got to be careful because, we're still very much in this downtrend, lower highs and lower lows on both the S&P and the Nasdaq. S&P is in fact hitting a new low in this downtrend. So the implied open is going to be around 4,200, low 4,200. And we're coming up to this very, very important support at 4,200 down to 4,100. So that 100-point range, we'll see if the buyers step in and if the bulls can have enough buying power to push the markets out back higher. But the bears are in full control right now. It's kind of been all bears over the last month and a half. So I just says don't buy right now though, right? This is just the tip of the iceberg. In my previous video, I mentioned that I don't mind starting now, and I specifically mentioned that I might be too early. And that's totally fine with me because, look, you're never going to time the top. You're never going to time the bottom. But it's just the process of understanding where the risk reward is most favorable for your investing style and your strategy and your portfolio and your goals. So for me, like I said, I don't mind Dollar cost averaging, that in fact, that's what I've been doing. I've been sending out alerts, buying, a couple different ETFs, VUG, SMH, and dollar cost averaging into individual stocks as well. Knowing fully though, like I'm fully aware and understand the markets can drop, another 5, 10, maybe 15% from here. But that's the if they actually do that, right? Maybe they don't. Maybe they do. Nobody knows, right? Nobody can predict the market. And like I said, nobody can time the top or the bottom. So it's just that constant analysis of risk and reward and what makes sense for you. So for me, happy to start the process, knowing fully that markets can drop here, and will be increasing my sort of aggressiveness of dollar cost averaging as we continue to slide lower and lower and lower. So it's, Q4 seasonality wise is the strongest. We'll find out, of course, if that ends up being the case this year. But if it doesn't, I'm happy to kind of turn the dial slowly and steadily towards buying more aggressively each week, each month, if we continue to see more selling pressure. If you're happy to just wait, be patient, be my guest. If you're happy to just go all in at these levels, be my guest. Do what makes sense for you. But it's, like I said, it's an analysis of risk and reward. And I think these are good starting points given how oversold we really are from a technical standpoint. That's what I was a little bit more surprised on from the markets as well, that we didn't quite see any follow through on the technicals. Because if you come over to some of these charts, like for example, S&P 500 stocks, how many of them are, below their 50-day moving average? So last couple of days, we did see some momentum back up, and now it's 88%. We were at 93% at some point, so we did see some momentum last couple of days, but it can certainly get down to the same level from back in September of last year. And think about it, right? We're back to the same level from back in September, October, maybe not from a absolute price level basis, but from a market breadth standpoint, that we've got the same percentage of stocks trading below their moving averages now, right? Over 98%, 99%. So that's why technically, we're coming down to some oversold levels. So that's why I don't mind dollar cost averaging. And that says time in the market outperforms the timing in the market. Totally right. So, obviously there's no point trying to time the market, trying to pick the bottom or the top. If the risk reward makes sense, just start the process. And that's what I'm doing now. Selling covered calls, rolling, and that's what I did, right? So that's what actually a couple of our members did. It was so crazy for Tesla because I ended up getting at 3:59 p.m. on October 4th, so a couple of days ago, 3:59 p.m. literally 1 minute before the close, ended up selling a call at $300 because the premiums are so high. And given how the last couple of days has been red, today's probably going to open down to the 3%. That call is going to print. And I'm just going to take the profits and just be on my way. So that's why it's like constant analysis of risk and reward, right? Understanding, okay, is it worth taking that decision right now, or are you better off just waiting a little bit, or just going in a little bit more aggressively? So if you have any questions on the macros, if you have any questions on interest rates, inflation, the Federal Reserve, FOMC, anything like that, feel free to comment, feel free to ask. I'm happy to go over those, but let's just quickly go over to the market's expectations right now. Still a 71% probability that we're going to see a pause. The market's really stubborn, isn't it? The market really is very stubborn. But what I will point out to, though, is not so much about November, but look what happened to December and January. So let me just go to compare. And I want to go over to December. So from 1 week ago, we have seen slightly higher increase in a potential hike here. So earlier it was at 31%. It slightly increased to 37.5%. And that pause has obviously decreased from 1 day and 1 week ago. It was at 64, 67%. Now it's at 56%. So what's really happened is the market's still expecting a pause in November, but the December probabilities have gone up. If you come take a look at this number, so only 56% now for December pause versus a 37.6 plus 6, that's 43%. Probability the market's going to see, Federal Reserve is going to hike 25 basis points, at least 25, if not more. So that's what's changed, is what I can notice from market's expectation after the report came out. Because earlier it was pretty much a done deal. Pause all the way through to June, July next year, and then 3 rate cuts in 2024, get them down to 4.5%. But right now it's a pause, and then the likelihood of a pause versus hike has somewhat shifted in December. It's only 56% right now. Okay, so cool. Yes, we'll take a look at Upstart from a long-term perspective. Upstart being a fintech stock, I think it's going to be more difficult for them to kind of, somewhat survive in this environment because, loan volumes have dropped, the frequency, the entire credit market has kind of dried up. And the fact that banks are also increasing lending standards is going to make that pool of borrowers even smaller. And that's another thing, right? And this kind of brings us to our point earlier that companies are keeping employees on the payroll because they had a hard time finding employees in the first place, so they don't want to start laying them off if they can continue to finance the payroll. But I broke down a report in one of my previous videos where we talked about how banks are tightening lending conditions for small and medium businesses and even large corporations. So what are companies doing? What is it that companies are doing right now to find financing? Let's see if you can answer this question. What are companies doing at the moment if they can't borrow the money straight from the bank? What are they doing right now to kind of meet that gap, kind of bridge that gap to continue to finance, continue to find the financing they need to continue their operations? So let's see if anybody can answer that question. So Viking says selling stocks, true, especially in the small, medium cap space. They are certainly doing a lot of equity, they're raising capital by issuing shares. Vol says corporate bonds, right? So yes, corporate bonds have actually seen a significant increase at the moment. Yes, diluting shareholders is definitely one of the big reasons, but the bigger reason is corporate debt issuance, and that saw the biggest increase in September across Europe and the U.S. I think it was like over $300 billion. So a lot of these companies, including big tech, including some of the smaller cap, mid cap companies, are issuing a lot of debt, whether it's convertible or not. They're issuing debt to raise the financing to continue to keep people on the payroll. So that's why the labor market continues to be tight. Because think about it, employees are the biggest expense for any company. It's not the marketing, it's not the R&D, it's not product development or anything. It's nothing. It's employees. Employees are the biggest expense for any company. They cost the most. So to finance all that, they need the money, right? They need either free cash flows from their own business, and if earnings are growing, right? The only other explanation is basically the debt, the corporate debt. Volatility right now is back over 19, so 6.7% increase. 20 is going to be that next level once again to watch. And beyond that, we're looking at 23.5. And beyond that, we're looking at 30. So those right there are going to be a few levels to watch for the VIX. No salary hikes. I think average hourly wages have been going higher, so I think they've still been increasing the wages for employees. Issue junk bonds, mostly for junk companies that don't have a lot of credit worthiness. So you're right, but corporate debt has increased substantially over the last few months. But then again, you got to ask the question, right? Man, it's such an interesting. We can go on. We can talk about this for hours, but then these companies that are issuing corporate debt kind of really helps us understand the risk appetite for the market, because this was one of the charts that I shared in my previous video, LQD divided by HYG. And you'll notice that it's once again lower. That simply means that investment grade is underperforming high yield corporate. And what that tells us is that market's appetite for risk is still pretty high. And it needs to be because the treasuries are so high, right? The bond market is so high, 6%, 5%. That's what everybody needs to beat now, right? Because if you were let's say if you're making 6% in your stock returns per year, that's no longer good enough. Even 8%, I would argue, is not good enough, because you're taking on all this additional risk to make 2% extra over the treasuries. So what one needs to do to increase their rate of return? what one needs to do to increase their rate of return. They need to go further out on the risk curve, take on more risk. And that's why high yield has been outperforming investment grade, because high yield corporate is basically made up of junk bonds, companies that have lower credit worthiness so they can pay a higher rate of return. And that's what investors are going after, because treasuries pushed everything out of the risk curve for investors. So they need to take on more risk and more risk to make up for that additional return. And that's why, at some point, if the yields don't stop and we keep seeing these increases in the 10-year yields, it honestly, and look, I don't say this lightly because I don't say it ever. If the yields continue to make a move higher like this at 5.5%, 6%, or even as high as 7%, I mean, that could really crush the market, equity markets more specifically. And I've never used the words crash in my video titles or ever, because I don't say that lightly, because the probability of that happening is really, really slim. It's really low. And that's why I never mention it. But if yields continue to move higher the way they are, if you get to 5.5%, 6%, 7%, 8%, yeah, you better believe it. That's going to be really brutal for the equity markets, because think of all the pension funds, hedge funds, sovereign funds all over the world. They're going to flood so much money into treasuries, get out of equities, because they can lock in 7%, 8% on a 10-year bond, that equities are going to have the worst time of their lives. Yeah, TMF is getting crushed, down 7%. Yeah, right now the bond demand is completely vanished. It's still there, more on the corporate side. I mean, it's still somewhat there, but it's not really there. And I think that's, obviously what Bill Ackman also mentioned, is that reason why the 10-year is not trading at a 6% handle is because bond traders have not seen yields this high in such a long time. So they want to take advantage of it, and they want to lock in these rates while they're available. M&A, who's buying the debt? I mean, a lot of investors, a lot of, institutional investors, a lot of foreign investors. There's always going to be buyers present. It's just the level of that demand is going to fluctuate. Yeah, the plunge protection team will step in again with all the printed money. Yep, so that's possible. They do that. So what they're going to try to do is they're going to try to buy treasury bonds again. And as the demand comes in, prices go up, yields come down, and that's going to push equity prices back up. But that's artificial intervention from the Federal Reserve to keep yields suppressed, to keep 10-year yields suppressed. It's not going to be a free market. And that's exactly what the Federal Reserve did during that quantitative easing, where they were buying billions of dollars worth of bonds each month, mortgage-backed securities and treasuries, to suppress the yields and provide that additional liquidity in the market. So Vault, what actually happened was we got the unemployment numbers at 8:30 a.m. Eastern. They came out very, very strong, 366,000, so twice as much as the jobs consensus expectations. Unemployment rate continues to be really low at 3.8%. Average hourly earnings were 4.2. The prior number also got revised. So not only did we get a beat on the current number, we got a beat on the previous number by over 100,000. So the market's really dropped. Yields continue to push higher. With this intense bleeding, one would have to pick specific stocks with a high risk reward, which specific dividend stocks one should buy in Redtober. It's kind of hard to say. I definitely do need the time to kind of process and play out the whole macro thesis in my head, because there's a lot that's going on from a macro perspective, especially when you kind of factor in where the risk curve is, where the yield curves are, and then where the risk reward trade-offs are going to be, considering how high the yields are. So it is a complicated topic, but yeah, I don't have any specific dividend stocks that come to mind right now, because like I said, it's gonna be a complicated discussion that we need to have with respect to the yields and how high they're going. So Frank says I'm going to be buying into REITs, into earnings. Yeah, earnings season is gonna get started here very soon. Yeah, we're going to uninvert soon. Yeah, so that number continues to move higher. As you can see, that this is on the way up. And that uninversion is the trigger for a lot of different things, including recession, including unemployment rates, unemployed persons, and all these different metrics. So I've Alicia for a while. Viking says, Caddy, how about O? I like O only if you've got a long-term perspective on these REITs. You know, it's obviously been selling off quite a bit, so it's at support now at $48, $49. So I like O. I like, Vici. I like Digital Realty. So there's a lot of these REITs that I do like from a fundamental standpoint, but you got to have a long-term perspective on these, because short-term interest rates are going to be cyclicals, and that's obviously going to affect a lot of these companies' fundamentals and revenues and earnings. But okay, yeah, so let's take a look at STLR very quickly. So Sterling Infrastructure, very, very massive move to the upside since 2022. It's up over 300%. Got pretty nice, consistently growing revenues, decent margins, 123% year to date. Earnings are expected to increase modestly, and revenue also expected to go up. We've got 21 times earnings, 1 time sales, 6 times cash flow, so not bad. And we've got about $147 million worth of debt. Low volume though, Frank, only 250,000 shares per day, which is, I guess, not the worst thing, but definitely something that's going to have some liquidity problems where free cash flow is consistently growing. That's fantastic. No dividends, and share count has also been going down. So that's exactly what we look for, although it's slightly up from on a year-over-year basis, but not that much. So it's a great company. I like it. I like everything that I'm seeing, at least from a early type analysis here. We'll take a look at in more detail what this company offers, both from a qualitative and quantitative standpoint. But overall, I think you've got something really exciting here. So, Eduardo, yes, you can tag me in the private chat and I'll definitely get to it. If you have a question around covered call, covered put option, so basically cash good put on a dividend stock in the Discord. So yeah, you can ask me here or you can ask me in the Discord. I'll be happy to go over that for you. So 15 minutes left for the markets to open. We're seeing a little bit of that recovery on the SPY. It's still down 70 basis points. QQQ is down almost 90. And we got the dollar index here pushing higher. The yields rotating back lower, but still over 4.8%. And overall, individual stocks also still trying to recover, but still very much red pre-market. Nvidia down 1%. Tesla's down over 2.5%. STLR, don't become Kramer. So why? I mean, STLR, I like did Kramer talk about STLR? Or STRL? These are two different companies, right? Yeah, STLR is not there. STRL is the one that we're talking about. Anyway, so yeah, if you have any questions, message me on Discord, email, comment here, and I'm happy to go over that. Make sure that you drop a like on this video. And we're going to end the poll now. Lithium stocks, Brian. So I don't know of any lithium stocks that might be interesting. If you have any companies you want me to go over, I'm happy to. Lithium Americas Corp. This one doesn't seem to have a lot of fundamentals on it, but slightly down. But yeah, if you have any companies specifically, I'm happy to go over those for you. HIMS stock, I've actually done videos on HIMS. Christos, just enter here. What's the ratio of payrolls and JOLTS is going to be 1.51. That's where we are right now. And that, again, is pretty high. We were at a lower number. Like if JOLTS hadn't increased the way it did. So if you come over to this calendar again, if JOLTS, you come over to this, it increased to 9.61. Consensus was 8.75 and prior number was 8.92. So if you plug in 8.92 here, this number would have been 1.4, and had unemployed persons slightly increased, let's say 6.5, would have been 1.37, even better. And I can bet if it was at 1.37 or lower, markets would have been in a much better shape, considering that that it's not as strong of a labor market anymore. But because JOLTS numbers came in so strong, unemployment numbers came in so strong, we're still at 1.51. I'm sorry, guys. It's just been long days every day with everything that's been going on in the market. So, DJD, when did you give me a company? GLBS. Okay, you can't just throw tickers out there, man, and then expect me to go over everything. Just give me something more to work with. What am I looking at for GLBS? What kind of questions do you have? Technical, fundamental? What does the company do? Like, you gotta provide me all that. You can't just throw a ticker out there and then you're like, what the heck? Gave you a company and then look at it. What do you think will happen with 10-year yields? Detailed questions, folks. Detailed questions. 2023. If you see 5%, above 5% significantly, then I guess it is better to risk than wait for stocks to go lower significantly. Where do I think they'll end up 2023? I do believe that I think it's going to be a little bit over 5%. Wouldn't be surprised if it's over 5% for the 10-year yields. Okay, DFLI for lithium, SQM for lithium. So we'll add those companies to the watch list and see if you want to analyze them. Technical analysis on SPY, and you look up. So we already have some levels to watch. Kevin, haven't had dinner yet, so we'll probably get something later. But so Mercado Libre, we'll do an analysis on that. MELI. Been meaning to do an analysis on this company for quite some time, but we'll do a fundamental analysis on this very soon, as they have now turned the corner towards profitability. So that's pretty good. Every single quarter, every single year, they are reporting some pretty good numbers. So. But low volume though, but we'll take a look at this anyway. So Coca-Cola buy here, Navdeep, I did a video on them yesterday. Definitely do check that out, and going over the reason as to why they sold off, and of course my fundamental analysis on that company as well. So DFLI and then SQM, we'll take a look at them and see if there's any opportunity for lithium mining companies. See, the thing with these commodity stocks obviously ends up being that it's very cyclical, right? It's very much dependent on the demand supply for lithium, and it can be very erratic, similar to what oil stocks or energy stocks are like, copper stocks, gold companies, silver companies. So these types of companies, they can be very cyclical. There's not a lot of predictability with revenue, earnings, and cash flows. So for those reasons, I try to stay away from commodity stocks as much as possible. They can be very volatile, but it still doesn't mean that we can't analyze them. So we'll add them to the watch list, see if there is any opportunity for us to look into them. Thoughts on the safe banking bill situation? Any thoughts on positions for MSOS? Okay, I haven't analyzed this. Seems like volume isn't so high. US Cannabis ETF. Yeah, I mean, safe banking, I think it's going to definitely help a lot of these types of companies. And, that's one of the reasons why Truliev's been higher. A lot of these companies in this sector have been pushing up, because a safe banking bill allows them to have better terms, better financing terms, better accessibility to finance, and that's only going to help them increase, their profit potential, their earnings, their investment potential. So, so it's got a lot of potential, but at the same time, not every one of them is going to be successful because right now there's too many companies in this space, and it's going to consolidate. I think we're going to see a lot of M&A activity in this particular sector over time, and how there's only going to be a few companies that actually benefit. So MSOS, as long as it covers some of the majority of them, I think it's going to be fine long term. But then you also have to kind of deal with that volatility because this sector can be very volatile. Leap, which city are you in these days? So I'm in Dubai right now. Been here for a few months, so we'll be here for like another month or so. Okay. All right, so market's going to open in about 10 minutes. SPY trying to recover. QQQ is trying to recover. Yields starting to roll over. So is the dollar after the numbers. And big tech still selling off right now with the spreads continue to move up. You got oil prices finding support at $82 a barrel, something that we have discussed previously. Very nice support at those levels. And volatility is also up 4.6% right now. And then quickly going over to Bitcoin, 27,000. Ether is just over 1,600 at the moment as well. What LNG stocks do you like, or just buy an ETF? Yeah, there's not a lot. I think there's a few companies that we already know, like in the natural gas space. So if you come over to energy, I think we do have a couple. Yeah, there aren't any pure natural gas plays, right? United States Natural Gas Fund. I mean, I think this one it's possible that it starts to see some potential upside here, especially going into the last quarter of the year. Although last quarter of last year was pretty brutal, but that was the entire market. And then you can see the seasonality wise, I mean, it starts to really rally, starting in September all the way through November. 78% move to the upside here. Almost an identical pattern over here. 60-70% move. And then almost an identical pattern actually here as well for UNG. From October to February, 68% move. So seasonality wise, I mean, last quarter of every year has been pretty strong for natural gas, rightly so. Except for last year. But the years before that, 3 years in a row, it's pushed higher. So MP Materials, I've done a video on already. If you simply search MoneyVest, MP Materials Analysis, you should be able to see that. In general, how is electric vehicle and battery sector trend going to be in future, next 2 years, for example? So money, I think it's going to be pretty strong. I think we've already seen the trends. I mean, year over year, numbers are growing for electric vehicle sales, and Tesla deliveries are growing, production's growing. A lot of that depends very much on lithium mining and the cost of lithium batteries and those types of trends. But I think generally speaking, I think it's in moving in the right direction, with not only the focus being renewable energy and kind of moving away from fossil fuels and carbon, but also just that's where we're headed, right? I mean, lots of people have adopted electric vehicles and battery technology over the last couple of years, ever since the pandemic. So I have no doubt that trend is going to continue. So Walt, I think this is the last jobs report we get until the next Fed meeting, but inflation data is going to come out next week. So that's going to be another really important report for us to look forward to. And the market is, as I've mentioned, stubborn right now, and it's been like that for most of the year. We've been talking about the discrepancies between the market and the Fed, and now it's only come down to one. From all the discrepancies over the last 6 months, now finally we've come down to one, which is fewer rate hikes in 2023. Federal Reserve is expecting one more. The market is pricing in a pause. Yeah, Qs are trying to recover. I haven't looked at NU Holdings yet. So 1 more month, cool, and then planning to travel again, but yeah. And yeah, most car companies are losing money on EVs, and that's good for Tesla, right? Because Tesla is one of the few companies that is indeed profitable, and it's got, you know, efficiency down really well when it comes to just making vehicles. So that definitely gives Tesla the upper hand over the long term, and not to mention the technology that they have, the amount of data they're collecting. All right, so 5 more minutes, folks, for the markets to open. So, Frank, how do you think the Department of Justice lawsuit will affect Google if they lose, positive or negative? For me, it looks like it could be a win-win either way for them. Love to hear your thoughts. So, I think a lot of these lawsuits that we kind of go through are oftentimes most of them are noise, right? For a lot of these big tech companies. Unless, of course, this starts materially impacting the company's revenue. So fundamental wise, if it starts impacting the actual company's numbers, revenues and earnings and cash flows, it doesn't really matter what goes on. So to your point, yes, I do think that as long as the company's fundamentals remain intact, and similar to, you know, that goes true for the FTC's lawsuit against Amazon or DOJ's against Google, as long as the numbers remain intact and that doesn't affect the company's revenues and earnings and cash flows, doesn't matter. Colby Caddy, won't Visa benefit from more debt? I mean, it's mostly the credit card companies that benefit from the debt. It's mostly the banks that actually issue that credit card benefit from that, because they're the one actually charging the interest rates on the balance. Visa's payment processor, right? The global network of payment processing. So the way Visa would benefit is there's a lot of volume, a lot of payment volume, a lot of transactions happening on the Visa's network. So it's mostly, they rely on a booming economy. They rely on consumer spending. They rely on total payment volume increasing. They rely on a lot of transactions happening. So that is what's going to benefit Visa more. By the way, we've got a Visa stock report coming out this weekend on our Patreon. So that's going to be available for everyone to view and analyze. We'll kind of include everything on that document. All right, couple minutes left for the markets to open. We're going to switch over to the S&P 500 here, the Dow Jones. We got the yields right over there, 5-minute charts. Do you think market is going to close in higher or lower on the day today, green or red? What does everyone think? Let's just do a quick poll, see where everyone is. Markets today, green, red, and flat. Can markets indeed recover? Let's see. They're trying to recover, but we'll find out, of course, if they can fully recover to green on the day today. But let me know in the live chat. Let us know where your vote is going to be. Vin says lower. It's possible that we kind of gap down, try to recover a little bit, and then, of course, continue to sell off intraday, given how strong the labor market is. I still can't. It's still unbelievable, right? 366,000 jobs. Like, where are these jobs coming from? A lot of them were government jobs. Some of them travel, leisure, hospitality. Then some of them private education. So technology lost jobs. Technology definitely is. You know, that layoff is coming into play. So 47% red, 37% actually people do believe the markets can recover and close green. 30 more seconds. Crude oil is back at support. So That's something to keep in mind because for the month, it is now down over 8.6%. But the inflation report's not going to account for that. The inflation report that we get next month or next week is going to be for the previous month, which is going to be 8.5% increase in September. That's what it's going to account for. Yeah, not started Fortinet position yet. We'll be looking at maybe selling some puts at lower levels, but we got 50%, so almost half of you expect the markets to be red. There we go. Market opens. Nasdaq here down 70 basis points. We got the S&P 500 also down about 0.5%, and the Dow Jones dropping over 22 basis points right now on the day. So definitely selling off quite aggressively. All three indices, well, I guess not quite aggressively, but definitely pulling back here with the yields still at over 4.84% at the moment. Volatility stays elevated, 4.65%. It's going to be quite an interesting day with big tech here down. Tesla's down 2.27. We got Nvidia here getting bought up as usual. Nobody wants to see Nvidia down. I think if I were to do a poll, how many people love seeing Nvidia red versus how many people love seeing Nvidia green, I think people would be like, we love seeing Nvidia red because it gives us the opportunity to buy it, but we just can't stand to see Nvidia red. And I'm kind of surprised how well it's held up given higher yields. Even Apple's kind of caved to higher yields. It's been down like 10-12% from its recent highs. I mean, Amazon's been selling off. We've got, Meta's been kind of drifting sideways a little bit. AMD's been selling off. Tesla's been pulling back, but Nvidia's like a real trooper. Nvidia's held up really, really well this whole time. I'm trying my best, Kevin, to jinx it as much as I can. No, I'm just kidding. No, but honestly, it's held up really well. Nvidia's hacked. Market cap at just over $1 trillion. I mean, it's kind of stayed up that threshold for such a long time. Anyway, so thank you so much for joining, everyone. It's been a long live stream. I really appreciate all of you joining in from, all different parts of the world. So thank you so much. I'm going to spend some time with our Discord members, answer questions there, and send out some alerts and send out some updates there. But thank you so much for being here. Appreciate you guys. Make sure that you drop a like, subscribe to the channel if you haven't already. And of course, links to our Discord Patreon is going to be down below if you're interested in joining us and getting access to, again, all the buy and sell alerts, options alerts, trade ideas, members-only videos, Excel spreadsheets, stock reports on individual companies. All that's going to be included. So thank you so much. Have a great weekend, all of you. And we'll be back at it next week on inflation data, which is scheduled for the 12th. So October 12th at 8 a.m.